Welcome back to the Stuff About Money podcast. I am Erik Garcia, certified financial planner, your host for today. And I am joined by he's become a good friend because we've talked so many times on this podcast. And I always joke that whenever John Hupalo is on, it means college funding is on my mind. It means I have big decisions to make because this is the most selfish guest. The guest isn't selfish. Me having John on is selfish because when I have college questions, I reach out to John. So John Hupalo, welcome back to the Stuff About Money podcast.
Eric, I love talking to you. And as you're saying that, I'm hoping that he doesn't think he has indigestion every time he has this particular guest on, because a lot of people don't like to talk about how to pay for college. It evokes all kinds of stuff, and sometimes it upsets some people's stomachs. So I hope you're in good stead, and we'll have a great conversation.
I'm good, man. I feel prepared. I feel prepared to have this conversation because I'm in the battle, right? Yeah. I'm experiencing the front line right now. We've had these conversations that I've got a senior in high school. We're making college decisions, and I am a financial advisor, John. Not just am I a financial, I am a certified financial planner, John. I am trained and I am equipped to make financial decisions and deliver financial counsel to clients. And yet here I am feeling lost and confused in this college funding decision. And I'm sitting here thinking like, my goodness gracious, what about people who are not financial advisors, who are not working with a college person? How do they navigate this, man? They're going into this, making decisions with eyes closed. And I always like to say, we want to make financial decisions with eyes wide open, regardless of what the decision is. You want to know all the consequences. So I am trying to ask questions, not just for me, but for people that I know listen to our podcast who have kids who are trying to make college decisions. So funding is a big one. Now, we have talked about this before. You go back, we've had, I think, 3 episodes we've recorded. In fact, the past 2 episodes, I think we've talked about funding specifically. However, those focused more on federal student loans. So right. let me do a quick 30-second recap for people. There's really 3 ways you can pay for college. One is you saved for it. The second way is you cash flow it with extra money, whether you as a parent or the student is paying for it. And the third way is you borrow to pay your way through. Borrowing, you can borrow the student can qualify for a federal loan through completing the FAFSA. All students are going to qualify for that. Over their college career, we're talking about somewhere around $30,000 is what they can get approved for. Right. And then we start getting into the more the more confusing gray areas because students don't have credit. They can't go apply for private loans. So they have to start relying on the adults in their life, i.e. the parents, to help them pay for college. So that's where I want to spend the time. We're cash flowing all we can. We're done saving. We can't borrow any more federally in the student's name, but we still have a big tuition bill to pay. How do we pay it?
Right. Yeah. And Erik, by the way, Invite Education, my company, started for precisely the reason you started this. When it's theoretical and you're telling other people about how they can help, they should pay for college, it's one thing. But when you're sitting across the table from your son or your daughter and it's them, that's how we started. I was in the exact same boat you were in. I said, I spent an entire career helping other people finance student loans. And when I sat down and started to go through the process, I felt like a deer in the headlights. So I called the guy who was my client and now a co-founder of Invite Education. I said, Peter, this is crazy. We've got to do something about it. And so you're talking
20 years, you and I might be business partners.
Yeah, it could well be. But honestly, it's that emotional stake in this is what makes this such a unique because, in the past, you and I have talked about being consumers of education, right? And that's really what it is. But it's different when the emotion gets piled on top of it. And that's what the true difference is with this purchase to any other one. It's not a car. It's not a washing machine. It's your kid's dreams that you're buying.
And you don't want to crush their dreams, right? You want to do everything as a parent to fund your kids' dreams. But there's a limiting factor, and it's money.
That's right.
And that is a real limiting factor that needs to be contended with. And as good intentioned or well intentioned you are as a parent, I think that you set not only your kid up for potential heartache, I'm not going to say failure, but I'm going to say potential heartache, and yourself up for heartache if you don't really consider the money side of it.
I agree. And the end of the day, it also, and this is the other thing about paying for college, it's completely different for everybody because your financial circumstances are completely different. So you and I, we might have like the same lifestyle, we might have the same bank account, but we might have a whole different thought about how we want to support our kid or what level it is. So when you talk to people and give them advice, it's never really specific advice. And what I love about the way you want to approach this is let's talk about it because, yeah, there are only really 3 ways to pay. And when you take 2 of them off and then you're sitting there as the parent saying, okay, what am I willing to do? What should I be thinking about, though, for my own future, for my wife and I, my retirement, whatever it might be? Maybe I have some other kids coming behind them. There are all kinds of factors. So this is a great conversation. I really give you credit for digging into it the way you do.
So, but before we get into it, I have to comment on one of those pieces of art behind you. Is that a Rodrigue? Is that a Blue Dog Rodrigue that you picked up in New Orleans?
That's exactly right. Thank you for noticing that. I actually, that's the only thing I've ever won in a raffle. I was down your way. I think you and I met the day that I was down there. Yeah. And they had a raffle, and I got to bring that home. So yeah, that's a Blue Dog.
Look at that! I'm like, gosh, that looks familiar, but
yeah. Thank you for noticing.
That's not New York art. That's New Orleans art.
No, it's in New York City, though. We love that.
All right, so let's jump into the conversation here. So we're assuming there's a gap in tuition from what the student is borrowing from FAFSA to the actual tuition, regardless of what that gap is. I want to start really quick, even though we're going to talk about private loans, I think we have to make a comment about the Parent Plus federal loan because that typically is the next place that people would go. And as we're going to kind of unpack here, you may want to reconsider that being the next place you go. Maybe you go there, but break down for us really quick how the Parent Plus loan works.
Yeah, the Parent Plus loan was designed to provide access to education. And so and I'll say this as someone who's studied this for a long time, you have to be really careful with a Parent Plus loan because there are almost no credit checks. The technical term is no adverse credit, which means if you don't have very long delinquencies and no defaults, you can borrow up to the cost of attendance from the federal government with no credit check. And also,
now, when you say be careful, that sounds like a great deal.
Sure does, except you also don't need any income, right? So there's no test. So a lender, any other lender would say, okay, how much are you making? Like, what can you afford to pay? That's what a private lender will do. I'll say, you know what? I'm sorry, but you have no income. We can't lend you money. The federal government, because where I started, they want access. They said, we're going to make this available to all comers. So they charge an interest rate that's higher than any other federal loans because it's made to folks who don't have any particular credit. They also charge an origination fee, which means that if you want to borrow $10,000, you're not going to get $10,000. The way it currently works, you get about $9,600, right around there.
4%. So you're going to pay 4% of whatever you borrow.
Yeah, it's actually a little more. It's like 4.23 or some number like that. So it's around. But it's less. Like, so you want to borrow 10, you're not going to get 10, and they'll give you up to the cost of attendance for all 4 years. So it's possible for a parent, and as you said, it's easy, right? It's the federal government. There was a lot of discussion in the last administration about loan forgiveness, including Parent Plus forgiveness. So when we'd have this conversation a year ago or 2 years ago, many parents would say to me, but John, the government could forgive that loan for me. Well, that's not going to happen, right? And so I say the Plus loan, and you said it the right way, Erik, it might work for some people, but I think this is one of those buyer bewares. We talk about being consumers, like buyer beware. Know what that loan is and just see what that monthly payment's going to be, and realize when you're looking at the first year, you're probably talking about 4 years. So multiply by 4 and figure that out. So
let's play this out. I'm a parent. My kid wants to go to school. Let's say there's a $10,000 gap. I'm going to end up borrowing $40,000 on the Parent Plus loan. Now, to be clear, the borrower is the parent, not the student.
Correct.
I am the borrower, not my student. And a Parent Plus loan does not allow me to add my student, even if they're able to pay later on.
That's correct.
Okay,
that's
so I'm stuck paying this bill, which might be fine. I might be okay with that.
Right.
but I'm going to be paying a abnormally high interest rate, having already paid a fairly high origination fee on this loan. And the scary part, you and I have had this conversation before about responsible debt and irresponsible debt. Irresponsible debt basically is you're borrowing more than you can really afford to pay on. There's a really good chance that the government comes in, or whoever the servicing, I say the government, whoever the servicing company is, comes in and says, hey, yeah, you don't make a lot of money, but we're going to give you this loan that's got a payment that might be 25% of your income.
Yeah.
10% of your income, which
or
is,
you have no income and you're on the hook. And it is the government. I mean, it's not, they don't farm it out to anybody. They have people who are collecting for them, but they're the ones making the decision. You file the PLUS loan application with the federal government right through the school. And some schools, by the way, your point earlier, in the financial aid award letter, they'll say, oh, and here's your PLUS loan. They'll almost make it look like it's part of the deal. It does not have to be.
Okay. So we both agree that Parent Plus loans probably are not the best way to go, particularly if you are credit worthy. I kind of hate how that term is credit worthy, because it sounds like an integrity thing. But anyway, the reality is banks measure your ability to pay back a loan based off of your credit history, how long you've been paying, do you have any defaults, do you have any bankruptcies, your income, and all those types of things. That's all credit worthy. Now, the problem is, what 18-year-old is credit worthy enough to go get a $10, $15, $20, $80,000 loan?
Yeah, none. Maybe Bill Gates' kids, I don't know, but not normal. Let me put. I guess normally you can't say that because that's also judgmental. But your typical student in high school is not going to get a loan from a bank. They're just not, right?
Because they don't have income, right? That's
like
the
number
one
thing. They don't have assets for the most part. Yeah.
So what do they do?
Yeah. So, what they do is they start by borrowing responsibly from the government. But as you said, it's capped out. Like whatever they can borrow from the federal government is kind of capped out. And then they typically turn to mom and dad and say, okay, here's what I want to do. How can you make this work for me?
So and now, rather than me borrowing as a parent, on the Parent Plus, I say, hey, you know what? I've got good credit. I wonder if I can get a better rate or better terms somewhere else.
Right.
Yeah.
Yeah.
And
in effect, you're lending your track record and your maturity as a borrower, right, to your son or daughter, right? It's a great trade because they
the Parent Plus loan, the parent is the borrower.
That's right.
In a private loan, now just to be clear, there are companies that loan specifically for college. This isn't like going to the bank and just getting a general loan. This is a specific student loan that a bank will give to the borrower in my kid's name, but me as the parent co-sign. So at the end of the day, if my kid can't pay it, I'm on the hook.
That's right. That's right. So, it's just not banks. There are credit unions. There are state agencies that offer these. Some of the financial services companies, big names. I don't want to say any in particular because I don't want to sound like we're endorsing any. And I think as a group, they do a good job responsibly trying to help parents understand how much they can borrow. But if your listener is saying, okay, where do I find one of these? The way to understand what the spectrum looks like is Google, find one of the marketplaces, and you'll see like the fintech lenders and the basically the banks, but also check your state. Like in Louisiana, LPFA has a private loan program. And oftentimes those state-based programs are even better because they can use a cost of funds, meaning what they borrow the money for to lend to you at a lower rate than even the bank. So they can pass that along.
Would I be looking in the state of my residence or the state of the college that the student attends?
Yeah, I would look in both places.
Okay.
That's right. I don't want to get real technical about this, but there are tax laws about that, and it's different in different places. But I would ask in both places.
Yeah, you talked about going to the marketplaces that kind of aggregate all these different lenders. A really good place to start is whatever university your kid has decided to go to. Talk to their financial aid office or the financial office. They typically have a list of companies that they work closely with. It's not the exhaustive list, but nonetheless, it's a list to get started.
Yeah.
So let's talk about how do these how do these private loans work?
Yeah, it's actually pretty straightforward. And the good news is it's set up now so that you can shop around. So, not to get crazy technical, but we talk basically about the sort of ante, the basis that the lenders are looking for, no matter who they are, is most likely your FICO score or some credit score. And you kind of alluded to this before, right? And you can go to like FICO.com, put your name in there, and they'll tell you what your FICO score is for free. So like that's a good place for parents to start. Like do a little credit check on your own, see what your FICO score is, and proceed that way. The other great thing is that when you go to one of these marketplaces and say, okay, I'm going to try this loan, they'll actually tell you whether or not you've been pre-approved. And the way they do that is they'll give you what they call a soft pull on your credit. So it's not a formal request from the credit agency for your score, but it's an indication. And so they'll come back and say, okay, your credit score is 750 or 650 or whatever the number might be. And by the way, for those who don't know much about this, the higher this credit score up to about 850, the better it is from the lender's perspective, meaning that you've been a really good payer over time, and they're going to give you an interest rate that's lower. So the higher your credit score, the lower your interest rate. And the inverse of that is true. If you have a low credit score, and a low credit score, we're talking here, call it in like the 700 range. If you're in a low credit score, you're likely from a private lender to get a higher interest rate. And when you were saying before about comparing it to the plus loan, that's really the crux of that. So the lender, the private lenders are going to say this, and I'll use your term, this is a credit-worthy borrower where they want to borrow $10,000. We think based on what we know about them, their FICO score and some of this income information we have, they're going to be able to make the payments. And therefore, we're going to offer an interest rate based on where their FICO score is. And that's how the lender actually differentiates one borrower from another and the interest rate that one person will get versus another.
So going the private, essentially the bank is underwriting me specifically based off of my specific financial background versus lumping me in with the masses. So
that's right. Just as if you went and you said, hey, I want to buy a house, like they'll tell you, okay, here's your rate for your house or your car, whatever it is. They're looking at you individually. Exactly.
Yeah. So, okay. So this sounds like for a parent who has good credit, this sounds like right off the bat, way better option than Parent Plus. Like what's the drawback?
Yeah. Well, first to support your point, I don't know the math exactly, but in the ballpark, if your credit score is generally above 725, you're highly likely to get a better rate than you would the plus loan rate, which is, as you said, one rate for all the masses. And you don't have to pay that origination fee. The private lenders don't charge an origination fee. So you are likely to be much better off, again, with a higher FICO score than you would be in the plus loan program. What's the drawback? The drawback is that the private lender is a private lender. So any of the government supports, like the payment plans for folks who may be having trouble and they have different income-based payment plans or whatever, those protections wouldn't be in place. And, we don't think you need to talk too much about loan forgiveness in this current environment. But at one time there was a conversation say, well, what happens if the government did forgive the loans? So those were two of the big drawbacks that you hear pretty fundamentally from families who are making these comparisons. But if you have a relationship with a bank right now or a credit union or even one of these state agencies, you're going to find that their repayment terms, they want you to repay that loan, right? Mm-hmm. Nobody wants a defaulter. The bank doesn't want somebody to not pay that loan. The family doesn't want to pay it. So if there is an issue, the private lenders also will work through and try to find some way to make a better payment plan. But out of the box, those are really the differences between the plus loan program and the private programs.
Now, the plus and the private. When do I start making payments? Is it immediately upon the loan being executed, or is it upon graduation?
Yeah, the private loans, and again, you need to check with the lenders because these programs change pretty frequently. So what I'm going to say is sort of a generalization, but that's some of the fine print that you want to read to make sure you understand that. For most of the private lenders, the payments start right when the loan is made. So you need to start making that payment. Some of them will allow you to defer until the student graduates. The one thing about these deferrals, Erik, is that I tend to think that it's not a great idea to take advantage of any of these deferral periods. And the reason for that is the interest still accumulates, right? So if I take a $10,000 loan, and this math, by the way, is not right, but just as an example, if I take a $10,000 loan and I wait a year or more to pay it, the balance that I will actually owe and pay interest on again is probably 10,500 or 700, but it's more than 10,000.
Yeah.
So I think if you're going to be disciplined, and we talked about smart borrowing and responsible borrowing, if you're going to take a loan as a parent, I think starting to pay that interest as soon as you can makes a lot of sense. So although there may be some deferrals in there and allow you to move that down the line, I think you're better off trying to make those payments right out of the box.
I can tell you this, just from experience and talking to clients who have student loan debt, it's a gut punch when they realize that their balance is higher than what they actually borrowed because they took advantage of deferral or even some of the other payment options where they weren't paying enough to even cover the interest, and all that stuff just accumulates. And like, we're talking about like thousands of dollars more than the original amount.
That's right. And Erik, I'll just say this also for the student. There are two, not to get too deep into it again, but from the student side, there are subsidized and unsubsidized loans. And it will say on the financial aid award letter which loans and how much of each the student will get. So if a freshman can borrow up to $5,500 their freshman year, I think it's $2,500 of that can be subsidized, meaning the government will pay the interest, or you don't have to pay. The borrower is not responsible for paying that interest. But
while you're in school.
While they're in school. I tell families all the time, I highly recommend that somebody pays that interest for the student while they're in school, so that $5,500 freshman loan is $5,500 at graduation and not $6,500 or some other number.
Yeah.
Right. Again, lots of times now at $5,500, even these interest rates, we're talking about monthly payments that are less than $50 a month. So I'm a big proponent of trying to make those in-school interest payments whenever it's possible.
Now, one of the things that we have not talked about that I think is a plus, that's not a good word to use in this conversation, a positive on the private loans is you as the parent are co-signing. You're not the borrower, you're the co-signer, which means that if your kid does go ahead and graduate and gets a good paying job and is able to build up some credit, you're able to remove yourself as a co-signer and you're no longer on the hook for that loan, correct?
That is absolutely right. And a technical term for that, co-signer release.
Fine print. That would be one of the terms that you would need to consider, but generally speaking.
That's right. And nearly all of the lenders, the private lenders, offer this technical term, co-signer release. And what that means is that they know that when they made the loan, I'll say to your daughter, since you have let's just say it's you. Okay, so you're going to make the loan to you, but your daughter they're going to make the loan to your daughter. You're going to be the co-signer. You gave her the credit necessary to get that loan. The bank doesn't really expect her to make those payments early on. So you're probably going to make those payments, definitely going to make those payments for some period of time. But then this happened with my daughters. They got out of school. They started to earn some money. They started to get a credit score of their own because they had an apartment. They were paying utility bills. All those sorts of things add to a credit. And if anyone's interested in understanding like what the credit score is all about, we have some articles at mycollegecorner.com about FICO scores, but just go to FICO.com or any of the credit, and they'll tell you exactly how you get a score, like what the 4 or 5 or 6 components are and how you can get that score together. So I highly recommend that people do that as well early on, just to understand what does it mean. But to your point, once the student's out of school, they have a job, they've gotten a little bit, they're in a position where they might be able to start taking responsibility for that debt. It may take 4 or 5 years, whatever it is, but they're going to have the opportunity to go and say to the lender, okay, I'm now not 18 or 23 years old. I'm now in my late 20s. I've got a job. I've been making my payments on my bills. My parents, I want to be released from this, so they can apply and the lender will say, okay, we agree with you. We're going to release your parents from this debt. Now it's just your debt going forward. And then you as the parent have been released. You've done a great job. You've lent your daughter, your son credit. You supported them for as long as they needed it, and now they're flying on their own. What a great moment.
So is it that simple? Is it a simple release, or is there a release and a reset of the interest rate based off of the rate, the current credit worthiness of the student?
Yeah, no, it's not a refinancing. It's just a straight, release. Now, there has been some research done about how often that release actually occurs, and the research is not particularly great. And I wonder sometimes, because maybe the students don't petition, or don't go back to the lender, but the actual cosigner release rates seem to be lower than I would have expected. But having said that, it is in that loan, and if the borrower, meaning the student and the parent, are thinking about this and planning for it, it should be something that you can take advantage of.
Yeah. So I want to drill down on something you just said. Plan for it. The importance of I'm going to talk about planning for college, not necessarily financially. Obviously, you want to save for college, but I think equally important, and this is something that you and I have spoken extensively on, is planning on having conversations with your student over a period of time, not in April when they have to make a decision in May, right?
Right.
But having a
Right.
conversation as early as freshman year.
Right.
My 11-year-old, we're having conversations with my 11-year-old right now about college, right?
Yep.
She's gone on some of the college visits with us, so she's hearing some of the conversations, and she's starting to think about what she wants to do. And obviously, 11-year-old, I mean, they're forming their thoughts, but like we are encouraging state schools, not out of state schools. Out of state tuition's a grind, sure. But having the conversation early with kids, so that these conversations are less emotional because they're all emotional, because you're talking about dreams and hopes, and you're relying on the decisions of others, right?
Right.
And how much aid they're going to give. Sometimes, you can do everything right. How many times have we seen this? A student's good grades, active in extracurricular, and great test scores, and they're left with very little offers. And
Right.
students who are, seemingly less qualified, walking away with big offers. It doesn't always seem fair.
Well, because it's not fair. And again, part of the reason it's not fair is that the school, up until the moment the student actually has to make a choice, the school holds all the cards, right? And they get to determine who they want to make the offers to. And they make those offers based on their business. And their business is to maximize net tuition revenue, which means, hey, Erik Garcia's daughter has applied to college, to this school, to our school. We like her, but there's this other kid over here who maybe comes from a different place, and for geographic reasons, we want to offer whatever it is. It doesn't have to be fair, right? And they don't have to tell you. And I know I went through this with both my daughters. Same thing. There were some tears around the table every once in a while. Like, well, how did this get in there? Or, this, I thought that. And maybe it's one of those, I've always thought of this as one of the really hard things for a family, because it's about separating emotionally also from like the ties that bound us all together, right? We raised these kids, and now they're like 17, they're college ready to go, and they want to fly off. And so like all this stuff is happening at the same time. And then there's thousands and tens of thousands of dollars of debt that has to occur for that to happen. And you're like, well, wait a minute, like this is an awful lot to come down, but it comes down on every family the same way, which we were talking earlier about, theoretical versus like when you're sitting across from your son or daughter, and we've all done it, who've done it. It's like, I know what I've told my friends to say to their kids, and I know what I said to my daughter, and it didn't always match up so well. Yeah. I'll just say that.
It's so much easier to give advice than it is to
much easier.
Take your own advice.
It really is.
But on that note, man, the power of a third party who's not vested, I say not vested in the decision, who's not ultimately going to be responsible for paying it, but someone who knows your situation. This is the advantage, quite frankly, of having a financial planner or a financial advisor.
Yes.
It's someone who's not directly invested or vested in your situation who can speak unemotionally and give advice that is consistent or in alignment with what's important to you.
And also, I think, Erik, keep you away from some of the landmines. And like, I'll say what I mean about landmines when we're talking about planning and paying for college. So you may be planning to take a loan or co-sign a loan for your student. But what happens in a situation where you read in some very reputable papers about, well, you should just take some money out of your 401k, or they'll make an early withdrawal, or like do some of these things that I think is just awful advice. When it comes right down to it, if you have to like imperil your retirement so your son or daughter can go to college, then maybe it is time for a big cry fest and say, we just can't do this, right? Yeah. I'm sorry, but like, I can't do this. And move on. But there are some things like that. The other I hear all the time is, well, I'll just put it on my credit card. Like you're going to go and pay like 20+% interest on your credit card. And so if you're of the means where I'm going to put it on because next month I've got so much money, I'm just going to pay it off and get the frequent flyer miles or the 5% cash back or whatever. Okay, go do that. But don't tell me that you're going to actually put it on and pay it over time. Like that makes no sense. So someone in your situation, a professional, my guess is you'd probably tell your clients, this is really not a good idea for you financially. And you're the adult in the room helping them over because of all the experience you have with others who've been in that circumstance. And you can tell them, this is what's happened. And I think that as a credible financial professional, it's I'm going to say you're duty bound to do that. And then the consumer, your client, has to make their own choice about what's going on in their family and what they're willing to do. But we talked at the beginning about sort of responsible borrowing and then excessive borrowing. And you just got to really be careful how far you're willing to reach for your students' dreams. Because some people do reach too far. We read about it in the newspaper.
Yeah. I was joking, kind of being truthful with a buddy of mine who's he's you and him are the two most frequent guests on the podcast, Dr. Matt Morris. He's a family therapist and couples counselor. And I always tell him, I'm like, man, when families are making decisions about college, when it comes down to crunch time, they need to hire you just to be in on those conversations. Because those conversations can become, they will be emotional. I mean, there's no way around it unless you just have so much money in the world, you're just going to do whatever you want with it. And that's right. That's one thing, but I mean, they're hard decisions, right? They're hard really decisions. Hard. Here's the thing. They're hard decisions. I think sometimes if your back's up against the wall, sometimes the decision's made for you. We just don't have the money, can't do it.
Right.
But if you're someone with the 401k and you've got some discretionary income, then all of a sudden you're sitting here thinking like, oh my gosh, like I could maybe do it, but then I'm not saving for retirement, or I'm extending myself a little bit more than I might be comfortable with, and that's when the decision becomes really hard, because if I say no, but then I can, and my value is to want to help my kid, then I feel guilty for that. Right. But if I say yes, and then something happens and I can't do it, then like, man, that was a terrible financial decision. That's when it gets hard. So when your back's up against the wall, when you're in that middle, that's hard. But when your back's against the wall, or you have unending amounts of money, it's a fairly simple-ish decision.
It is. And I go back to the axiom that I try to live by whenever I can, when I'm not breaking my own rules. But, that's plan for the worst and hope for the best.
Yeah.
And just look at this market environment we've been in for the last 6 months or so, right? And if you're in, I think about people like you who are about to pay that first college bill, and some of them probably had an awful lot more in the bank account that they did just 6 months ago. And so you're saying to yourself, well, wait a minute. And there's no guarantee the market's going to go up or that it will drop, or who knows? So what you're saying, I think, is right. It's the people who are stuck in the middle. And I always, the other thing, I don't think we ever mentioned this, but when I talk to families or do these kinds of discussions, I always say, this is the time to be realistic, right? There's no time right now for optimism or pessimism, right? It's just not going to help you. Those are emotions. But realism, the reality of it, like, what do you have? What do they need? What are you willing to do realistically? Like try to step back and use that as the bumper. What are you going to do when you're throwing that bowling ball and you want to go right down the middle, but it hits the gutter? Like what's going to happen?
Yeah.
And no one likes to think that way, but unfortunately, I've learned through my career, you have to be burned enough times to know that that's the better place to be, because I have wound up on the wrong end of something to say, oh, this is going to work out okay. And it didn't. Right? It doesn't have to end well. Now you can plan for it to end better. And I think that's what we're all trying to do. And financial professionals like you help your clients do that. But the best piece of advice I try to give people is be realistic right now. This is the time to be realistic, and throughout the optimism, throughout the pessimism, and get the family together and talk about like what can actually happen and what everybody needs to do so everybody has the best outcome that's possible.
Yeah. I think it's so important that people go into this decision with eyes wide open. Like know all the options. I'm not saying private versus parent plus. I'm not saying this versus that. Know your options, know the consequences of those options, and make the best possible decisions, right? And hope for the best, right? Maybe between now and graduation, your student qualifies for a scholarship that they otherwise didn't qualify. Maybe they end up not living on campus and save 25, 30, 40% of that expense.
Right.
You just don't know. Maybe, there's a scholarship that comes up or a grant or something that they qualify for.
Right.
You don't know. But go into this with eyes wide open. Something else I like to encourage people to do is, before you have to start paying for college, before you borrow, start practicing making that payment. I love this. Whenever someone's thinking about buying it, when I'm talking to a young couple and they're thinking about buying a house, or someone's thinking about going to college and there's enough runway, we say, okay, let's do the math. It's going to cost you X amount a month. Let's practice making that payment now, and go open up an account, call it your kid's name, college.
Right.
And start making that payment into that account. If you're going to borrow and it's going to cost you $750 a month, start paying $750 a month. By the time they go to college, you'll have a few thousand in there, maybe for initial startup costs, or you'll have a few months of tuition, or you might find out that, hey, you know what? I can actually borrow less because I'm saving this amount quite comfortably, and I can maybe stretch myself somewhere else. But doing it without the pressure of actually having to make the payment is freeing.
Yeah, that is great advice. I actually hadn't heard that before, but I'm going to start saying it because I think it's really spectacular. The other thing that I tell folks, the ones who have saved, they might have a 529 account or something like that, is when I did this personally. So what I tell them is take out this next year's and put it in as like the most conservative option you have on money market. Within the 529 account, they'll have places where you can put the money where it's not at risk in the market. And so I say, like, use this year's and then next year's too. So if the market swoons or there's some big drop, you know that you've got this year's and the next year's that you've allocated put away as a little nest egg, and it'll be there for you. And then, as you're saying, things change every 6 months, every whatever. You have a better chance then of getting through an extended period when maybe the markets aren't doing so well. So it's kind of akin to what you're saying about practicing that payment. I think also getting your savings into a safe harbor, a safer place without a lot of risk in the market within that period I was talking about. I think that helps as well.
Yeah. Again, it's being thoughtful and thinking through and trying to the extent that you can, get ahead.
Yep.
Right. Plan for several contingencies, plan for several things to go wrong, because there's nothing worse than not being prepared for some financial emergency or crisis. And not necessarily paying for the college might be the crisis, but man, you're paying the tuition, everything's good, but you are right up to the edge of your budget, and then the transmission goes out, the AC goes out, or hurricane hits and you got a deductible to pay, where there's no room for margin.
Yeah, Erik, there's one other thing we've never talked about this before, and I've just kind of tripped on it. And we're talking about, generally, I was a risk manager in the job I had before this. So I think about like, what are the risks? And one of the risks that is current that didn't really exist 10 years ago is that a student goes to school, they have trouble handling it for whatever reason. They get sick, they have to leave, they have emotional issues, but there are some number of students who leave during the semester. I would recommend folks go and look at a company called Tuition Guard, tuitionguard.com. They have programs there. And again, maybe not for everybody, but if it's worth taking a look at. They have relationships with 600 or 100 or 700 schools or whatever the number is, but it's a large number. And what happens is if the student has some kind of issue where they cannot complete the semester and they've passed that withdrawal where the school will give them a refund or, any of that, Tuition Guard has some programs where they'll make those payments as long as the doctor says, this is that kind of situation. So again, this is I'm not endorsing this. I'm just saying that if you're in the business of, thinking about and planning, I would just take a look at tuitionguard.com and see if they have a program there that makes sense for you. As I looked at it, I didn't think it was crazy expensive by any shot. So I would, again, just throw that out there.
You have a blog on My College Corner about that, don't you?
That's correct. We did.
I think I just saw
exactly right.
Yeah.
Right.
So if you visit John's website, mycollegecorner.com, there's a lot of really good resources there. So I highly recommend you all check that out. But John, there was a lot of good information in this podcast. I'm gonna go have my kid and my wife listen to this. I told them, I said, I'm talking to John today so we can make decisions. No, decisions already made. So, but it's always refreshing to talk to you. It's always refreshing to not feel like you're unique in your situation, right? There's comfort in commiserating with other people.
Yeah, no, Erik, there is. And I'm glad that we can talk about it in these real terms because it's real people making real decisions that have real impacts on their lives. And very few are going down a path for the first time alone. So by talking to friends and neighbors and those who've been down it, hopefully there is some comfort and maybe a few tips along the way too. I love your idea about, practicing to pay. I think that's really spectacular. And hopefully, your listeners have some ideas. If they want to contact me directly or have ideas for like what they'd like to see on the blog, send it to John at inviteeducation.com. We take those requests and turn them into blog posts every now and again, or directly interact sometimes with families. And if we don't know the answer, we can help get people the help they're looking for. So I love being on your show. It's really a blessing for me.
You also provide other resources, webinars, and whatnot on your site, correct?
Exactly right. Yeah, it's all free. mycollegecorner.com is the place where you can find that, including some like a scholarship search engines there. And I'm really stoked about this next one. We're going to put up in the summer a student and parent loan navigator. That's going to let the students see what their federal loan will look like and then give the parents a place where they can actually compare private loans one to another and compare those loans to the PLUS loan.
Oh, wow.
So you'll really get a really good indication of like what the total family debt will be. The last tab on that will be all the loans together. Here's what the kid's borrowing. Here's what the family's borrowing. Here's what the monthly payment will be. And importantly, if you pay interest in school, here's what the savings will be. I'm really stoked about that. And we'll share that with you, Erik, when
is that launch?
Hopefully soon. We have the beta test out now. We've got some folks kicking the tires. So I hope it's coming really soon, but certainly before this next school year starts. Absolutely.
Awesome. John, it's always good, man. I appreciate it.
Yeah, my pleasure, Erik. Be well. Good luck. And I'm really happy that you're at this point in your life where you're starting to see this happen in real life because it'll help you with your clients. So love being with you. Good luck, brother.